Welcome to the Heart Red Spade podcast. This podcast features long-form conversations with accomplished guests from across the globe on topics ranging from financial markets and trading to psychology, entrepreneurship, and life in general, with your host, Adrian Alberts. Derivatives trading carries significant risk of capital losses and is not suitable for all investors. Past performance is not indicative of future results. All views aired by participants are their own and intended for informative and educational purposes only. Always consult with a registered financial or legal advisor before acting on any topics discussed. Today, I have a very special panel of guests over here, and I'm going to start ladies first with Ayesha Tariq. She's a CFA. She's based in Dubai, the co-founder of Traderade, and very, very well respected and someone I've got a lot of respect for. We also have Mayhem over here, based all the way in the States, the co-founder of Traderade. He was also on the show before, like Ayesha, and he's going to be discussing the macro side and a lot of other things with us today. And we have my friend Tim Vollans. Welcome to you too again, Tim. Tim is the co-author of Macrodesiac. I thought I would have him on board today because I like to get different opinions on different things. And guys, I'm very excited about this episode. I've never actually done a panel before, so let's see how this works out. I'm sure it will go very, very well. And just want to say welcome to all of you. Thanks for doing this.
Thank you for having us.
Thank you.
Perfect. So Ayesha, I thought I'd start with ladies first. Earnings. That's the big thing that we are facing at the moment. Now, if you look at into the cyberspace ether, you would have noticed a lot of people are saying this is going to be a horror show and this is terrible and so on and so forth. But do you think this is a case of absolute hell that is awaiting us, or maybe a situation of, well, not that horrible but still pretty bad? What do you see?
So it depends on how you look at it. Okay. So there are two things here. One's the estimates and one's the actual earnings. Okay. If you look at the actual earnings, I think we've been trending down for the last couple of quarters, and rightfully so. I think what you're going to see here is definitely another quarter of earnings that where you see like very minimal growth. I was looking at some of the numbers before we came in. The earnings growth for this quarter is about 2.4%, which is still quite high when you compare to bear market earnings from the previous bear markets that we've had. I think the lowest one was, I think, sometime in the 1980s, like the early 1980s, when we had an earnings change of 4.5%. So, but other than that, if you look at the decline of peak to trough in earnings, it's about 20% decline across the board for the S&P. So if you see it from that perspective, we're well above, or at least the growth expectations are well above what they should be for a bear market. Now, having said that, something that we saw last quarter was a lot of the analysts becoming overly pessimistic, and they started to take down earnings estimates right before earnings. And as a result of which, what you saw is a lot of the companies did come out and beat those estimates. Now, unfortunately, I think the market has become a lot more naive than it used to be. So a meet beat or a not beat makes a big difference over here, because all we're seeing are the binary numbers. Did they beat? Did they not beat? We did see some, some recognition of what's going on within the companies themselves, as and when, for example, the earnings call started, or when more information came out on what exactly the company is doing and what they will be doing. However, it still remains, the beat or not beat still remains the major driver of, let's say, a pop in the price of a stock during earnings season. So if you look at factoring in for these beats in the past, what FactSet has come out with, they came out with like a really nice study which shows that technically we're looking at a 6 to 7% earnings growth over this quarter, which again, in my opinion, is pretty high compared to what I think we should be having. So
if you were to put an estimate on what you think we should be having, where would you place it from your personal perspective?
So I think I would probably come out somewhere at flat, so zero earnings growth. So obviously you have some of that being pulled up by the energy sector, which is seeing, you know, a massive amount of revision upwards in earnings because of, you know, the price of oil. But on the whole, you know, I still think that we should be flat. I mean, for example, let's take XLK, which is like technology, right? Earnings for technology have been revised down by about 5%, which is nowhere close to where it should be. If you consider the macro environment, and if you consider that most of these are high beta stocks, I think, you know, a 4 and 5% downward revision in earning is not, you know, steep enough. So coming back to your question, whether this is going to be a horrible season or not, I think we see a lot of surprises. Yes, I do think that we will see a lot of surprises. And I do think on the whole, this earnings season will pull the market down further. So we will, you know, see another leg down in the market.
Yeah, I wouldn't be surprised by that. I mean, what do you think of this, Tim?
Yeah, I mean, I totally agree. I definitely think, you know, there's a lot of scope for disappointment in the earnings season coming up now. I think you've really got to sort of dig beneath the numbers as well to figure out what's going on at the moment. Like, if you take a look at Nike was a great example, who reported recently. They had a massive inventory build. Essentially, I mean, the simple version of it, I'm going to get it up for the figures in a second here. But the simple version was that all of their inventory came at once. So they had a couple of quarters of kind of almost backlogged inventory that came through as supply chains were improving. But then they also got through all their seasonal stuff early because they tried to order ahead of time to deal with the supply chain issues, which obviously were no longer present. So they've now got a massive sort of inventory build, especially in the US. And Morgan Stanley had the data on it here. I think it says, yeah, it's increased plus 65% in the quarter. Okay, so that's like a massive build compared to what you would normally expect. And they're expecting discounting, you know, across the board for all of these companies that have got these overstocking issues, you know, such as Nike, Levi's, you know, in the clothing sector. And then you've also got obviously the semiconductors, which are just completely in a different stratosphere, really, in terms of their overstocking. And now you're finding as well that all the demand for kind of the PC, you know, smartphones, even potentially iPads. You know, I was seeing something yesterday from an analyst on you know, potentially iPads not being replaced at the same rate. You know, there's a lot of downside risk, definitely. And I mean, and that's aside from the overall macro environment as well, which obviously isn't supportive.
Yeah, no, I agree. Sorry, go ahead, Mayhem. I see you were saying something.
Oh, no, I wasn't. I was just thinking and typing and doing a little research. But I think everything that Ayesha and Tim have said are 100% dead on. I mean, the average recession, which we're technically in, but it's a pretty soft, just technical recession at this point. But in an average recession, earnings drop about 30%. We're definitely seeing signs of slowing from the consumer. When we look at real retail sales, they've been flat to down since May of last year as appetites shift. And we also see that PC sales just dropped nearly 20% year over year. This is the biggest drop in 20 years. Mobile phone sales, as Tim alluded to, are also falling pretty rapidly. This is putting pressure on chip makers as Intel is starting their layoffs. So net, what we're seeing is just more and more downward pressure on businesses. Consumers are pulling back their spending on everything that they can. They're deferring purchases. So the idea that people wouldn't buy a new phone, iPad, or computer, that they would defer that purchase is realistic. They would even be willing to defer the purchase of durable goods. And I think that just speaks to where we are. We have historically bad consumer sentiment. We have businesses that have enjoyed a very generous business cycle for the better part of the last 13 years. And now we have to reconcile with the reality. As Warren Buffett said, when the tide goes out, we get to find out who is swimming naked. And I think we're going to see a lot of that.
So the chickens have come home to roast, never mind roost, if we can put it that way. Yeah, look, it's been a very interesting environment, and as the Chinese like to say, may you live in interesting. How does the two-part curse go again? May you find what you're looking for, and may you live in interesting times. I think that's actually playing out at the moment, and I mean, it does seem to me whenever I look at, say, the S&P 500, because that's obviously our most well looked at instruments in the world, I would argue. The market is clutching at straws for any bit of good news to try and find a bit of a rally wherever it can. But then you find a situation like last night, for example, where Governor Bailey came out and said, "You've got 3 days," like some kind of a mafia don who said, "Well, you know, if you don't, then well, you know, this will happen," and no one actually knows what will happen. But I don't know who wants to take this one, but doesn't this guy have coaches telling him what not to say in public and what to say?
Clearly not.
Sorry, go ahead, Tim.
Clearly not. Clearly not. If he did, then he wouldn't be saying the things he's saying. I mean, the whole issue, I mean, I get where he's coming from, right? The whole idea is basically that the bank can talk, you know, they can come in and say, "Listen, we'll help you out for a bit, but you sorted this, you know, you caused this problem. So now you need to fix it. We'll give you 2 weeks to do it. That's your window. You lot get it sorted, and then we'll be out of it again, like we've always said we're going to be." But then to reinforce that, and sort of when there was kind of I think an implicit assumption that it might be extended if it needed to be, and in the same speech talking about the risks to financial stability that were being caused by this thing. I mean, like, what kind of message did that send to anyone, let alone financial markets? I mean, imagine trying to run a business with that kind of messaging.
Yeah, but this is a major global
no one
central
knows.
bank.
Yes.
This is not. Sorry, go ahead, man.
At least they have a good sense of humor. The Bank of England came out today and warns that if difficult economic conditions continue, UK households may face a strain as great as before the 2008 financial crisis. So, you know, they're funny guys over there. They're not only warning about pain to come, but they're going to create that pain to come.
Lovely, you know, so we create the pain and then sell you the product to ease it.
Or not, you know, we'll sell it to you for 3 days, but then you're done.
Jeez, but what exactly are the ramifications of this? I mean, for anyone watching this and who doesn't know about this kind of stuff, what could this cause? Let's say they don't get it sorted out in 3 days, for argument's sake. What happens then?
So I think the Bank of England will have to come back and backstop them, because if you look at what's been happening, and I've been following this pretty closely, it's now a feedback loop among the pension funds, right? So they had no choice but to do liability-driven investments, because that's how their pension funds are structured. And they are one of the largest holders of gilts in the UK. Now, when the rates started spiking, for example, they started dumping in like quantums that nobody had seen in the market, right? So what we saw was usually like about 12 billion trading in bonds, and they were dumping up to 50 billion, which is an inordinate amount. You know, it's almost like over three times, right? And so when you see something like that, actually it's 4 times, not 3 times. Yeah. Yeah. So when you see something like that, and now they are held hostage by, the margin calls that they're getting on their leverage. So they had to hedge many of these investments. And when they did those hedges, obviously they had to post collateral. Now, the funny part about posting the collateral was much of the collateral was also in gilts. Okay. So here you have like another loop. So not only do you have to put up cash, which you don't have, if you need to sort of, so your gilts are now losing value. So you have to sell more gilts to make up the value of the collateral. So it just like goes on and on and on, and you're just spiraling downwards, right? Now, the problem is they're at a Mexican standoff, let's say. These guys have to make good, or else they're going to default on their hedges, right? And then If they default on the hedges, there'll be like even a larger call and everything will be liquidated. So if they liquidate everything, that's going to be even worse for the Bank of England, because now you're going to see even worse fire sales, because it's going to be across the board, everything is being liquidated. So either they have to come in and sort of negotiate something with the banks with whom that they've done the hedges with, or the Bank of England will have to, step up and say, hey, even if we are not doing any purchases, we will be there to support these gilts in case of, because what's happening now is with the price of the gilts, spiraling downwards, a lot of people are losing faith in the, in the value of the gilts, which is never a good thing, right? So your collateral value is just falling and falling and falling. And at some point, if you lose faith in the government or the government's ability to back these gilts, you're going to be in big, big trouble. The whole country is going to start to unravel, like the whole financial. And this is why they said, it is a major risk to the financial system, because losing faith in the government paper is like the worst that can happen, right? So I don't know what happens, but I do think that he might not have to take his words back. Maybe he has until the October 14th or whatever. I mean, that was the date that was set earlier anyway. But I do think they will have to come to some kind of understanding if they don't want this to get worse.
And two incredible stats to add on to what Ayesha said. The Bank of England owns 70% of the free float of gilts, where some have fallen as much as 75%.
Good heavens.
Yeah.
Wow. Jeez. Okay. Yeah, that's definitely not particularly good. Sorry, Tim, go ahead. You wanted to say something?
No, that's a great stat. And also it's another reason why the government can't go off spending, as they thought they would be able to, because they were still thinking about the old regime where they would get money from the treasury, from the central bank, from the remittances. So that funding has also dried up. So they're talking about sort of tax cuts and, lots of spending and everything else. And everyone's going, well, where are you going to finance this from? And they go, oh, we'll just do it. Don't worry about that. Everything will be fine. Let's just go for it. And I think that this isn't just something that's, maybe it might be worse in England or, in the UK, because of perhaps the way that the new government's come in and kind of, they've taken the first shot at the kind of the next step in, in a new regime, perhaps, and trying to get ahead of it. But so they've taken a lot of the bullets, perhaps, for what will likely have to be some very difficult things, negotiations around the world, as we try and sort of go from this old kind of QE, low rate addicted marketplace to something that kind of more accurately reflects reality. Now, what that will be and where that will settle, I mean, if you guys have got any ideas on that, I'd love to hear them, because I really don't know where we're going to go with all this. There's so many possibilities, so, such a range of outcomes here that I don't know where we're going.
I think it's a great question. And I think it's a very important discussion to have, because we've gone from an era of abundance of capital, of resources, to an era of scarcity, both artificial and natural scarcity. The artificial scarcity of capital in particular here is a big concern. And I think that because we're not engaging in any sort of policy to resolve some of the core drivers of the problems we're confronting, that these same things are likely to come back and greet us in very unpleasant ways. So, for example, we're not really expanding our production capacity. We're not expanding exploration or even transportation. In doing so, we're setting ourselves up for, sure, the central banks of the world can destroy demand, maybe even commensurate with their policy goals, by inducing a deep, unforgiving, and long-lasting global recession. But as soon as that gets deep enough, something big will break. And inevitably, central banks will have no choice but to come back, cut rates, possibly engage in QE. Speaking of England, the House of Lords once did a study that indicated that no central bank anywhere in the world had ever fully normalized their policy post-QE over the intermediate to long term. So not only was the last 13 plus years of unprecedented monetary and fiscal stimulus a grand experiment, but so is the period of time that we're in now. There's never been anything like this, and it's likely to lead to financial and economic calamity, because the central banks that are engaging in tightening don't really know what they're doing because no one's ever been here before. So I think what we could reasonably expect is shorter, more shallow credit cycles, greater amounts of volatility, inflation remaining a persistent problem for many years to come, for many credit cycles to come, because over and over again, the fiscal side gets whacked in the face. They know that they're creating demand with their bills, including this chip bill in the US, as well as the ironically named Inflation Relief Act. But at the end of the day, what they should really be doing is trying to expand the elasticity of the supply side. And yet I haven't seen any governments really doing this in a meaningful way. And so I feel like we're destined to repeat these mistakes. And it also goes back to what you said earlier, Tim. You have governments, businesses, and consumers that are used to a multi-decade trend of debt becoming cheaper to service. That's over. And for how long, who knows? But there's a lot of folks out there who have tremendous amounts of dollar-denominated debt that is sensitive to US rates that are also caught on the wrong side of this, both tracks going against them. So I think it's dangerous. I think that we have a lot of things that are creating these sort of negative feedback loops. And eventually, probably sometime next year, something very big is going to break and create a financial crisis. And I would guess it's going to be a sovereign. And maybe based on what we're seeing, it'll be a European sovereign, UK or another country, I don't know. But I would say that that's probably the pivotal event that brings central banks back to the table to say, hey, you know what? Even though inflation seems to be structural in nature and we're doing our best to destroy demand, saving the financial system from a depression may be the bigger concern. And so they come back to the table, they stimulate, but inflation comes back much earlier in the cycle because these multiple decades of disinflation or low inflation, they're over for many different reasons, but primarily because the supply side remains inelastic. And as soon as demand comes back commensurate with anything resembling enough to foment economic growth, it's more than likely that inflation is going to come back. And the bigger problem here is also, what is inflation, right? We're measuring the rate of change for prices. Well, what about the prices themselves? They're not necessarily going to fall very much, especially in the stickier areas. So the next bout of inflation is going to start from higher prices. So that's another concern to kind of add on to all of this. In a situation where consumers are up to their eye holes in debt, they're leveraging up on revolving rates, debt facilities like credit cards and home equity lines of credit to try to stave off the pressure on their cost of living. And what's happening to the rate of that debt? It's surging too. So it's kind of the perfect storm. I feel like it engenders the likelihood of financial and economic calamity. I think it could be a very bad one. But I do think central banks come back and we kind of go into this fits and starts era where we have shorter credit cycles, more shallow bull markets, and more volatility as a baseline.
So you think another 13-year run is, nah, that's not easily going to happen again.
Almost impossible.
No, I'm inclined to agree with you. And I mean, you mentioned something very interesting there about the whole supply chain, or rather the supply side issues. Now, I spoke with someone that I know who works in logistics and mentioned to me that one of the big reasons why the supply chain issues actually came into play was because a huge number of vessels were decommissioned during the whole COVID era. And I asked the question in my ignorance, well, why don't they just recommission them? And then she said, well, it's not that simple, because when a ship is decommissioned, it's actually essentially sent to the scrapyard, because it's more expensive to recommission a ship than to actually build new ones. So apparently new ships are coming to the fore at the end of Q4 of this year and the beginning of, and towards the end of Q1 of 2023. Now, with that, what's the word I'm looking for? Would that reduce the supply chain issue to enough of an extent to reduce inflation? Or do you think this is just going to be like putting a Band-Aid on a gashing wound?
It's one step. Sorry, go ahead.
No, yeah, I was going to say pretty much the same thing. It's one step in, and it's possibly coming at the worst time when demand, especially for goods, seems to be coming off the boil completely. So you're going to have more shipping capacity just at the time we don't need it. It's the typical bullwhip kind of effect where, you build these ships for the demand that we had a year and a half, 2 years ago, when shipping costs were just going right through the roof. Now shipping costs, I don't know if you've seen how shipping costs are falling. It's drastic. I think 36% in the last 4 weeks alone on the Drewry's index. Just massive falls. And what's going to stop it when you look at all of the things that are kind of being overproduced? you know, where we've got these big inventories sitting around everywhere. You know, as long as they're roughly in the right place, we don't need chips to move them around anymore. So we're probably going to see that will be the one big disinflationary, maybe even deflationary aspect, sort of, I think, coming into the next sort of 6-9 months.
Go ahead, mate.
Oh,
okay.
well,
No, maybe you wanted to say something about that.
well, I just wanted to add on to the point I was making earlier too. One of the things about the last 13 years that was somewhat unprecedented is a lot of forward returns, like a lot of the future returns were being pulled forward. So the other thing about this cycle is we probably took like 20, 30 years worth of returns and compressed them into just over a decade. And I think that's another, I mean, if you look at things like Schiller PE, you can see we're way out of bounds with where valuations should probably be. You could take into consideration how low rates were. They're no longer that low anymore.
Mm-hmm.
And you could take into consideration how accommodative, you know, the environment was for businesses to continue to expand, but with rates where they are now, that's no longer true. So I would say that, you know, to Tim's point, yeah, there's a lot of demand destruction. There's a lot of inventories that are significantly higher than they should be at a lot of these retailers, and there's reasons for that. It's that bullwhip effect again. Late last year, remember, everyone was panicking to get their gifts for Christmas, and a lot of people were dealing with stuff that was out of stock. So retailers went significantly the other way and say, hey, let's get as much of that as we possibly can, just as the consumer checked out and said, you know what, I've had enough. So I agree, the idea that we're going to see these new chips being brought in, as we can see across the board, whether it's Shanghai, Los Angeles, Shanghai, New York, Rotterdam, New York, Shanghai, Rotterdam, all these prices are collapsing. Some as much as 66, 70% from their highs.
Wow, that's quite considerable. But yeah, it's amazing how the right thing happens at the wrong time, and that can just have the complete opposite of the desired effect. And I mean, speaking of
about the generals in the last war, isn't it? They're always fighting the last war.
Yeah, that's actually a good way of putting it, Tim. I mean, speaking of inflation, I mean, we're expecting 8.1% tomorrow, but I think if we don't hit that, then we can probably see a repeat of last month, where we fell nearly 200 points over 2 days, I think it was. You know, and then we are well below the 3,500 mark, and then those pandemic highs are definitely in sight for the S&P.
Yeah, Cleveland Fed is actually looking for 8.2% year over year on the headline. So that is a little bit concerning. They're looking at 0.3% month over month. Both of those are higher than the forecasts. So they have a pretty good track record, and I wouldn't be fading them on this. So I would say we do have the potential for probably a lukewarm CPI. I don't know that it's going to be hot, but I think it's going to be more than what people expect. The maybe one area that works to the advantage of CPI is energy was pretty volatile in September, particularly crude oil. So maybe there'll be some downward pressure there. Maybe there'll be some downward pressure on utilities, since piped gas, natural gas prices have gone down considerably as well. But net, you know, food prices pretty flat, shelter prices probably flat to up. I mean, a lot of the inputs here aren't necessarily showing us signs of their velocity abating.
You know, Ayesha and I were actually talking the other day when I had her on the show about the stickiness of food inflation. You know, it's almost like sticky toffee pudding that just doesn't wash away easily unless you have really warm water and soap. What do you think? Is that still going to remain a problem for the foreseeable future, Ayesha?
Yes, and I'll tell you why. I was actually looking at something a little bit earlier in the day, where people are actually shifting more towards cooking at home versus eating out. Because if you look at, you know, the price or the inflation level or the price increases in eating out, you see that's pretty steep as well. And when you compare that to, you know, the growth in grocery costs versus eating out, it's obviously a lot more. I mean, it's hurting the consumer a lot more. So apparently somebody did a study on how much people are cooking at home, and they're cooking at home a lot more than, you know, going out to eat at all. So you'll see like a lot of the restaurants as well giving out massive discounts. And I think this is another area where you'll see a major drop in the restaurants. But at the same time, so the only reason people were actually going out was to drink. So they were still going to the bars, but when it came to food, it was more consumption at home. So I think what we're going to see is it still remains quite sticky. And one thing I think Mayhem and I were discussing the other day as well was people don't necessarily need to pass on, the reduction in costs right away. And when you see, so for example, like a Walmart, their discretionary spending has come down, right? So their discretionary items are not being sold as much. They're having to discount those items a lot, again, because of the inventory glut that, we were discussing earlier. So they need to make that up somewhere, right? And therefore, they probably won't bring the cost of food down immediately because that's what's selling right now. And that's what will continue to sell. So I think it's a bit to do with the retailers as well in not jumping and, bringing costs down as quickly as, you would think. But also at the same time, the shift is towards more grocery spending, which again will keep the prices elevated in, grocery items.
Yeah, Mayhem alluded to higher prices earlier, and I make him 100% correct on that. Many years ago, my dad told me about this. He was a photographer, so he used to buy a lot of film and all that stuff. And silver, to my surprise, was a big component of actually producing film prints. And he said that apparently what happened back in the 80s was silver had a massive spike. So Kodak went and more than doubled the price of their film. And when the subsequent collapse in silver came, actually way below to the original price, they only dropped the price by about 10%. So maybe we'll see something very similar with food and other prices over here where they say, oh, look at us, we're giving you discounts, but it's nowhere near what it was prior to the spike in the first place.
Yeah, absolutely. I mean, I saw I saw a small headline which said, Prime Day discounts might actually be higher than previous prices. So even after the discounts, you're paying prices that are higher than regular prices. Sorry, go ahead. I cut you off.
Sorry. I thought you were waiting. No, I was just going to say that the PepsiCo results they came in as well just before we jumped on the call. And their average prices are now up by 17% from a year ago. So they've got slightly lower volumes, but their prices are up by 17%, and and their margins are still relatively healthy. And they're just able, and I think they were almost bragging about it in the last quarter as well. Saying how they could just keep raising prices, and people were paying them. And as long as they get away with it, they're going to keep doing it because, why wouldn't you? All your input costs have gone up. Obviously somewhere along the lines you've had a few, it doesn't all just go linear. You don't just sort of like step, if your input costs go up and you go up by this much, obviously there's lots of different input costs, especially in a company of that size. But they're not going to be in any rush to bring prices down. Obviously they've got slightly different motivations than perhaps the retailers who have got these inventories to clear. But someone like PepsiCo, with all the, obviously because it's the food brands that they've got as well as the drinks. Why rush? Why rush? As long as people are, as long as they're turning that sort of, enough volume that they're making good revenues and earning on them, then why are they going to be in any great rush to lower their prices?
But maybe
what's the competition?
Maybe they have a bit more room because these are what you would call low involvement purchases. It's not quite the same as buying a car or a house or something major. If you're paying 17% more on, what does the soda cost in the States, Mayhem, roughly speaking?
Oh boy, I don't know the last time I drank a soda.
Oh, okay. No, I don't drink this stuff. That's why I thought I'd ask. So I have no clue.
Yeah. No, I do think though that net grocery prices have been going higher. To Ayesha's point, the other thing is eating out has just become too expensive for a lot of people. If you're seeing your budget constrained, you're going to try to downsize everywhere you reasonably can. And when you're eating out, sure, you get a good portion, but it costs a lot more money than making something at home. And, if you want to factor for all costs, and I don't think most people do this, but the healthcare costs of eating out a lot also tend to be much higher than eating at home over the long run.
That's actually a good point. I actually read an interesting stat the other day that the US spends the highest amounts on healthcare of any country in the world. I think your average is something like $11,000 per person or something like that.
And yet our health outcomes are tantamount with countries that spend 80% less.
Yeah, and that's got to do with
we pay for the Rolls Royce, we get the Kia.
Oh, yeah. That's actually quite awful.
Yeah, it is.
Yeah, because you and I were actually chatting about this, funny enough, during one of our off-camera conversations, was how food quality, for example, has deteriorated a lot over the years. So even though you pay more for food, you actually get less in terms of the nutritional content. So yeah, it will have an effect.
And it's interesting you mentioned that, because there was a recent study that was done, a pretty large peer-reviewed study that looked at processed food and said that essentially it is a cancer catalyst in no uncertain terms. And it has everything to do with the deterioration in quality of ingredients, the fillers that are used, the artificial flavors and colors and preservatives, the high sugar content, the lack of nutritive value, the lack of fiber. It's kind of the perfect storm against the human body, and maybe even has to do with some of the chronic disease being higher than it used to be. So it's a catalyst for healthcare, but it's bad for the average person.
Yeah, and that will also have spillover effects to the rest of the economy. I mean, especially if you start having some kind of an epidemic. I mean, look at what COVID did to us, for example. It just obliterated the economy. So if we have other forms of epidemics, which have longer lasting and higher costing effects, then yeah, perfect storm, as you mentioned earlier. That's a great way to put it.
No doubt. It's sad to see, but you know, as investors, we do have to pay attention to these trends, because sad as it is to say, it is a boon to the healthcare services industry, because there's more people that will have to rely on more frequent doctor's visits, on more medication, on more kind of interventive therapy, and at an earlier age. I mean, you have people as young as 10 years old, children with diabetes and heart disease and other kinds of illnesses that you would never have seen earlier.
Yeah, no, it's definitely an issue. We spoke earlier, for example, about you know, shorter credit cycles and you know, the economic pain that actually awaits us in the near term and probably even the medium to longer term. What can the Fed, for example, really do about that? Because as we know, they can't stimulate that they can't do anything about supply issues. But are we going to get to a point, and anyone can take this one, whoever feels they don't know the answer to this one, is there going to, are we going to get to a point where central bank stimulation will simply not have the same effect? And to Mayhem's point earlier, before we got on camera, it's like giving a cancer patient painkillers, but no other form of treatment. I mean, are we actually getting there?
It's a really big question, and it's a very important one. I don't know that I have the intellectual capacity to answer it, since there's almost infinite variables to model for it. But I would say that, you know, within the next several cycles, it becomes more likely that we see something like that. But we also see that there's going to be countervailing forces pushing against central banks, because inflation used to be cyclical. It is no longer cyclical. It is structural in nature. And that is a central bank's worst nightmare, but it's also a debtor's worst nightmare, because it just portends to the idea that rates have to continue to go higher to destroy demand, since a lot of the demand, especially in the United States, is debt driven. So you raise those rates, you get rid of that debt-driven overconsumption. That's great, but that's only ephemeral in nature. You can only have a deep recession for so long until something big breaks. So they could come back on the other side of that, and they can stimulate, and they can certainly get us out of a recession. They could bring the financial markets out of a bear market. But I think the bigger question is, for how long and with what second order impacts? Because like you said, they can't, the Fed doesn't have a magical printer for cotton or crude or copper or other commodities. And until we expand supply commensurate with the growing world's appetite for it, these problems are going to continue to come back, and they're going to come back earlier and in more vicious ways. So I think it's maybe not so much that, you know, central banks lose their ability to impact markets. It may be more that markets start to push back earlier and earlier, because in that sort of environment, the other thing you'd see is the bond market's going to start selling off when it sees inflation, even before the Fed begins to intervene. So maybe that could be a countervailing impact on what Fed policy would want versus what the market does.
So we essentially need to be smarter and wiser with our financial decision making going forward. You know, it's kind of forcing us to actually be more Darwinian in a way, adapt or die.
Yeah.
Jeez, yeah. I think, well, it just shows that the free ride is essentially over, you know, and I think maybe in some ways we're actually, one of the guys that I was speaking to on FinTwit the other day actually said that something that he's noticed with bear markets is that they actually create more of an honest environment. It separates the proverbial chaff from the wheat. You see who's really got the skill to be able to trade or to invest properly and who doesn't. So maybe we're kind of returning to those kind of markets over the longer term.
I
think so.
Yeah,
I think so. I also think that we're not going to have an easy ride anymore at all. I think that, you know, we're not going to just have a market that goes from the lower left to the upper right of the chart. There's going to be a lot more volatility. There's going to be a lot more fits and starts. There's going to be longer periods of sideways markets as well. And then if it's a sideways market during a period of reasonably high inflation, it's in real terms a market that's going down. So I do think it's going to be a much more challenging environment, in particular, going back to my earlier point, because so many returns were pulled forward, particularly during COVID, but really over the last 13 years, there's a lot of sort of catching back down to reality to do.
Yeah. Sorry, go ahead, Tim. You want to say something?
Yeah, no, I was mainly agreeing, to be honest. I think that's absolutely bang on. I've kind of, the idea of the returns being brought forward as well, it's sort of like you say, all of this stuff, all of these growth companies have been sort of built on the idea of kind of growth in the future. And obviously that growth now, it's either happened or it's not going to materialize. You know, it's like it's one or the other. Either way, there is no sort of real exponential growth anywhere. But the one thing that I kind of come back to, and this is one of my weird theories that I like to throw out, is what if things get bad enough that we end up seeing a kind of almost a merger again between, you know, the sort of supposedly independent central bank and the government, and perhaps, you know, kind of like we had after the Second World War in the US. You know, there was a sort of a period of financial repression where, you know, real rates were highly negative. The government was obviously spending, they were building out the capacity of the economy because obviously they had all these troops coming back. They wanted houses, they wanted to buy durable goods, all that sort of stuff. Obviously, it might not be exactly the same this time because we haven't got that kind of overseas returning demand. But perhaps from the supply capacity perspective, you know, particularly with energy, and this doesn't just go for the US, I think we could perhaps see this more in Europe if they can ever figure anything out, is this kind of, yeah, Ayesha knows what I mean there. It just, if that sort of is where we're going to go, it's kind of one of my sort of weird theories that I can't substantiate with much, but kind of like, if things get bad enough, I don't see why we would just go back to an era of financial benefit, shall we say. It might be an era of real economy benefit in terms of where the central bank steps in to support things, and they would have to do that jointly with the government. That's essentially what I'm getting to. What do you guys think of that? Do you think that's likely in any scenario?
I don't think so. I mean, in Europe, perhaps, but in the US, I don't think so. I think, well, I think they do rely on each other a bit too much already, I think. But, you know, the truth is they were made independent for a reason, the Federal Reserve. And I think they need to remain independent, because having said that, I think the one thing that they should probably do is not join forces, but at least speak to each other. So when you have like the government going out, and the same thing which happened in the UK, right? So you have the government and the exchequer going out and saying, you know what, we're going to do fiscal policy, or we're going to do fiscal stimulus. And then suddenly the Bank of England or the Federal Reserve says, wait, what? We're trying to tighten, and you're going out and doing fiscal stimulus. So yeah, I mean, I doubt they will join forces, and I don't think that they should. However, I do think that they should coordinate their policies among themselves. One thing Mayhem and I were discussing after Jackson Hole was that we felt that one of the reasons that Jay Powell was a little bit upset, probably, or a little, you know, he was a little angry, let's say, it was because right before that you had the announcement of the Inflation Reduction Act, right? Which is again sort of fiscal stimulus. And then a few weeks later you see the Bank of England and the government do exactly the same thing. So this kind of stuff needs to stop. There has to be a balance between the two, and they have to coordinate their policies, because one is negating the other, or at least creating, I mean, it's wreaking havoc on the country.
That's a tug of war.
Yeah.
Absolutely. And guess who's suffering? The people.
People.
Because yeah,
As
it's
always.
the people who are paying for this, right? Whether it be in terms of inflation or whether it be in terms of bailing out people. So the thing that Mayhem said about, you know, a credit event or something, if we do have a credit event and the government steps in to bail that, you know, company out, at the end of the day, it goes on the people. Because it's not the government per se who's bailing people out. It's us, right? Because our money goes into the government. So I think they need to sort of, as much as they think that it's their money, it's not. It's the people's money, and they need to be cognizant of that. And I think they need to coordinate better, as opposed to maybe joining forces.
Yeah,
I would, I agree with everything Ayesha said. I would add to it, it kind of goes back to my point earlier that there's too much short-term can kicking. It's what you all were saying as well. And the government is especially bad at this. I mean, at least the Fed tries to take a longer term view, but our legislative branch and our executive branch are notoriously short-sighted, to the point where everything is about the next election cycle. Everything is about placating voters. It doesn't matter that, you know, the best idea for the types of stimulative policy that they're doing now would be to do it during the depths of a recession and not the tail end of an expansion period where we're seeing the economy running a little too hot, where there's inflation, where we don't need any more demand-driven pressures. And I 100% believe that, just like Ayesha was saying, that Powell was genuinely perturbed. He was perturbed by the actions of the legislative branch. He was also perturbed by the reaction of the market to his July press conference, because, you know, people were saying, oh, the Fed's going to pivot imminently. And he didn't say anything that even remotely portended to that outcome. So, you know, you have a lot of impulsivity across the entire system, whether it's businesses, government, or individuals. And some of that leads to very poor outcomes, a lack of planning, a lack of foresight. These structural imbalances build and build and build. And now we're in a very leveraged world. We're in a world where, you know, government debt to GDP is over 100% in this country. And if you factor all the private debt, it's enormous. It's something like 350% total debt to GDP in the United States, which is the highest I think it's ever been. So with interest rates going up and the Fed tightening, the consequences are pretty stark, but you still have a government that doesn't get it. In fact, this same government, by the way, was telling the Fed, hey, you made this inflation, you fix it. Not remembering that they literally had a government helicopter spitting
Stimulus
money out
checks.
to people. You know, it's just like trillions of dollars coming out from the government money helicopter. They're like, no, it's your fault. It's not our fault.
Yeah.
Never mind the fact that you all were the ones that monetized that debt. But, you know, at the end of the day, I think that unless we have prioritization of longer term societal and economic planning, these socioeconomic problems, these imbalances are only going to get worse over time. And like Ayesha was saying, the real consequence is the human impact.
Yeah. And it's like The Big Short, one of my absolute favorite movies, and that scene where Steve Carell's character, I think he played the role of Steve Eisman, if I recall correctly. Correct me if I'm wrong. Where one of his mates said, "Yeah, but the bankers are going to jail. You know, they're the crooks," and he said, "No, I have a feeling that it's going to end up the same way as before, where poor people and immigrants get the blame for everything." I think that can happen again. Sorry, go ahead, man.
Yeah, it's interesting you mentioned that, because during the 2008 great financial crisis, in the wake of that, you know, Obama was elected and he promised to rein in Wall Street. Of course, none of that happened, but he appointed Tim Geithner to the Treasury, who, you know, was set to oversee the IRS and didn't even pay his own taxes. But hey, that's okay, because he also said, let's not prosecute any financial fraud whatsoever. He leaned very hard at Eric Holder, who was the Attorney General at the time, saying, if you do that, it's going to erode trust in the system. Now, of course, I take the opposite view. I think prosecuting fraud increases trust in the system, because you know there's actual justice. But you're right. It often is the case that, hey, let's take someone like Bernie Madoff. Let's blame him for the entire great financial crisis. And here we go. You know, we have a scapegoat.
Yeah, the human element, or rather the human nature element, never seems to change though, and that is where I think a lot of our problems come in. And I've said this to Tim before. I think Mayhem and I have also spoken about this on prior occasions. But the problem that we have in modern society is that we are not biologically evolved enough for the toys and the systems we have created. And that is essentially one of the big things, is that we have these very complex systems. We have these very complex technologies and things that we have, but we are not quite yet at the level to handle it. It's like we've from a certain respect, we've won the lottery, but we don't know how to handle all this money that we have. It makes us go insane.
It's okay. We can light it on fire to keep ourselves warm this winter. But if you think about it, evolution, yeah, exactly. Evolution is not going well. I mean, if you talk about physiological evolution in a society such as ours, where you have so many sort of antagonists for epigenetic development, you know, your genes are being damaged by your environment, by what you eat, by what you drink, by your stress, by lack of sleep, and then you're passing on those damaged genes. And then you also have a lack of anything resembling survival of the fittest. Not that I want to live in a society where survival of the fittest is the mandate, but without that, you know, there is no evolution. There's nothing that even vaguely resembles evolution. If anything, you could say, genetically speaking, we're going backwards. Yeah. But I think the other thing is, intellectually speaking, we're also going backwards. And it's amazing to live in a time where you hold the compendium of humanity's actuality in the palm of your hand, connected to every single person on earth that has the internet, to all of our knowledge and all of our information. And what do we do with that? We send each other cat gifts.
Yeah, let's be honest. And it's interesting you say that, Mayhem. I spoke with a friend of mine who works in digital marketing and social media and all that. And she asked me, how long do you think the average attention span is? I said, well, I heard 7 to 10 seconds. She said, oh, you're being generous. It's closer to it's actually closer to 3 seconds now that the average attention span is. 3 seconds. Yeah. I mean, bloody hell, that's worse than 10-second Tom in 50 First Dates. At least he had 10 seconds before he forgot his own name and introduced himself. But 3 seconds. Wow, what does that tell you?
We've become goldfish.
I feel we're being insulting to them.
Probably so. They probably have better attention spans than we do. I mean, look. I mean, we're all on Twitter in some variety or another. Yeah. It's a perfect example of creating a dopamine cycling addiction where there's low effort, there's a moderate to high reward, the likes, the gratification, whatever, sating our ego, our appetite for validation. That creates an incentive system that completely distorts normal, everyday jobs. Like if you have to mow the lawn, no one's going to like your lawn mowing. It's certainly not going to happen in 3 seconds. So everything just gets distorted, right? And the problem is that we don't even really want to use dopamine as our primary motivating neurotransmitter. It really should be serotonin for a more even kill, especially when it comes to trading. But this is one of the things that exacerbates it. We're not only in an increasingly ADD world, we've gamified everything to the point that it's taking people who aren't ADD and giving them ADD-like symptoms, including that compression of attention span.
Mm-hmm. Well, the gamification that you just mentioned is really, really interesting. I never even thought of it that way before, but I saw another study a while ago that where they said that we are all essentially addicted to our phones. You know, we'd like to say that we are not addicted to anything, but all of us are literally addicted to those things. It's one of the reasons why when you alluded earlier to sleep deprivation and stuff, why people actually get sleep deprivation, because of looking at screens so often, that it actually distorts our ability to filter out between natural and artificial light, or something along those lines.
Yes, blue light actually suppresses the release of melatonin, which in turn distorts the circadian rhythm that governs our sleep cycle.
Yeah, I spoke with a friend of mine a while ago too, who also mentioned something interesting, and I would actually like anyone's opinion on this one, or all of your opinions for that matter, where he made the interesting comment that with boomers retiring now and passing on their wealth to Generation X and Generation Y, we might actually be seeing a market structure that's forming where increased risk taking might become more of the norm. Because boomers obviously came out of the war, so they were taught to, shall I say, respect money a little bit more, be a bit more cautious with it. But we haven't had a major war in the last 70, 80 years. And as Mussolini, don't like the guy, but for anyone who wants to make any accusations, but he said that the world needs a war every 50 or 60 years for people to realize how good they actually have it. And we've had it good for so long, but that's also affected the way that people perceive, especially millennials and Generation Z, perceive risk-taking and money. Money is so plentiful that maybe we'll see a lot of this volatility going forward.
Adrian, there's clearly no evidence of that happening. NFTs are not a strong indication of people mismanaging their money. Come on, man.
I was about to say, I think we're already having it. It's already happening. It's not the future thing. We're living it now.
I wanted to be generous, geez, I wanted to be slightly generous. But okay. No,
but I think it will continue. I do think it will continue because, you look at a lot of those people, they're just going to think, well, the system's against me still, as they have done since the whole Occupy Wall Street thing after 2008 and where Bitcoin was born was on the back of all of that. The system's against me. Why aren't I just going to YOLO into whatever the thing might be? Maybe it'll be energy stocks this time, why not?
And it's interesting too, because if you look at the crypto complex, however it may have come into existence, it was brilliant in one particular way. It provided a relief valve for excess speculative liquidity that if that had not existed and that money found its way into stocks and real estate and bonds in the real world, we would have seen asset inflation and real world inflation worse. Instead, you had something like $3 trillion enter things like Bitcoin and digital monkey JPEGs and so forth. And that took that money out of going into the real world and out of the financial system. So in some sense, it was helpful. Although I think hopefully, I really hope and pray that it's also been a learning experience to see something that was aggressively marketed as a hedge against inflation fall 70% in 7 months during the most intensive inflation any of these people have experienced during their lifetime should be a bit of a wake-up call. I hope. We'll see, right? That 3-second rule.
Here's hoping.
There's something to be said about this, though. Yes, it's a good thing that there was a relief valve, but then if some of that, and this is just for argument's sake, if some of that money actually did get plowed back into the stock market or get plowed back into even the bond market, for example, that would actually increase investments, capex, and perhaps, a lot of the investments that we've needed to do away with the scarcity that we are seeing now. So in a sense, yes, creating this bubble, I mean, the money went somewhere at least, which maybe didn't create a bubble in stocks, but maybe some of it going back into stocks wouldn't have been such a bad thing because it probably would have fueled a lot more investments. I mean, it's just food for thought,
No, it's
But do you,
great points. Sorry, go
do you
ahead.
think that millennials,
incentives, go on.
I was just wondering, do you think that millennials and Gen Zers would have appetite for real world companies? Because it feels like most of their investments is very speculative, very growthy and techy and sort of new world kind of stuff.
And the funnier the name, they more want to go for it. Like, as my mate, whom you all know, Chris, said, imagine going to investors and pitching and saying, by the way, we have Pudgy Penguin in our portfolio. He said, that wouldn't go down very well, now would it? But those are the kind of things people trade nowadays with these weird
It's okay.
names.
We've hedged our Pudgy Penguin exposure by shorting ApeCoin. So like we're pretty delta neutral.
Oh my goodness.
But no, I think it's a good point that Ayesha makes, but I just don't, I think it's something, I don't think it's been a shortage of capital that stopped that. I think it's been a shortage of incentives. Everyone that's been involved in the companies, all of the shareholders, all the executives, everyone that's involved in that decision-making process has just been rewarded for, I suppose, financial engineering. There's got to be obviously some company growth to go alongside it, but taking the risk of actual investment, and really saying, no, this is what we're going to do. It's not a risk that's been incentivized by the kind of the structure that we've been in. Maybe now once reality kind of hits again and all this scarcity really sort of hits everyday life, for people. Because I mean, even now, we're talking about it because we pay attention to markets. But you talk to like anyone in the outside of our little kind of markets bubble, and they're not really aware of it beyond the sort of headlines, the normies, yeah. They're not really aware of the stuff that's going on and the implications of it, and you're trying to get the message out to them that they're not ready to process it yet. And sort of, so I think once you kind of get into that real world where everyone's experiencing it, then maybe you might see a shift in some of the incentives, what some of the companies decide to do. You know, perhaps obviously, you know, the debt servicing costs are going up as well. So that might have an impact on the, you know, the decision to actually invest in longer term things, as we've touched on already. But yeah, I do get what you're saying, but I just don't think that the capital scarcity has been the problem for company investment. I think it's just been the incentives are messed up.
Yeah, I think the incentives are thoroughly messed up, and not just in companies themselves, but at the government level too. There's this magical thinking that we can just build a bridge to green energy by doing all the things to do away with hydrocarbons without actually building that bridge.
Yeah.
And it doesn't work. The world runs on hydrocarbons. It's like 80% of our energy is oil, gas, or coal. There's no way to just end that paradigm. We need to continue to invest in it so we have an abundance of energy to build a future where we're less reliant on that form of energy. But because governments rely on this 2 to 4 year cycle of kicking the can down the road, telling voters what they want to hear, and living in a fantasy land, we've had more and more restrictive regulations. We have this ESG nonsense that is disincentivizing investment into these very industries. And it's just created a sort of feedback loop that, you know, whatever you're looking at, if it's energy, if it's agriculture, if it's base metals, there is a very significant lack of investment, and the government has done everything they can, unfortunately, to engender that environment.
Ma'am, how do we counteract that though? What would be I mean, it's a fantastic breakdown that you gave over there, but is there a way that, you know, governments and I'm not being facetious when I ask this.
No,
it's just, what would be the best way to counteract that? Because we're dealing obviously with human nature, with a short-termism, as you mentioned, you know, the whole election cycles and stuff. Is there any light in the damn tunnel over here?
I laugh because it's the opposite of everything we're doing right now. I laugh because, you know, the reality is a tragic comedy. The government is leaning into demand when they need to lean in supply in terms of what they're doing on the fiscal side. The central bank of our country and around the world are increasing the costs of debt. And these energy companies and miners and otherwise, they're usually somewhat leveraged. So if anything, if you're at the seat of a company that produces essential raw materials or energy or otherwise, or farms, and you see the cost of debt going up, you see the economy slowing, you see the government doing really nothing at all to help you out, if anything, the opposite, what are you going to do? Are you going to ramp up production in that type of environment, or are you going to scale back to try to be more conservative as business conditions are disfavorable? So I think we're doing all of the wrong things. I don't think we have much of a choice from the perspective of the Fed, because they've been put in the impossible position with their very limited set of tools to try to subdue historically high inflation that is partially driven in no small part by demand, but inelasticity on the supply side is a huge structural problem. And then the government is saying, you know what, we're going to blame you for all that, and then we're going to add fuel to the fire. So I think if anything, we need to be doing the exact opposite of what we're doing. I don't know exactly how it would all come about, but I think the debt service costs for companies that are involved with these very critical components of our society, producing energy, producing materials, producing food, they should be afforded some kind of government subsidy if they're investing in growing that capacity, so we can actually grow supply during a time where it is scarce. We don't see anything like that coming down the pipe, but that would be, I think, an important structural change. We also need to deregulate some of this stuff until we do have an actual abundance and a bridge towards a more renewable future. And quite frankly, we need to, I mean, I could go on a soapbox about this alone. We need to completely reinvent how we do agriculture. These giant single crop fields of genetically modified organisms that are completely saturated with fertilizer and herbicides to the point that it's wiping out the Gulf of Mexico. It's destroying arable land. I mean, our farming as it is now is at odds of feeding the future of humanity. We can't keep doing this. We have to go to biodiverse farming. We have to go to more sustainable agricultural methods. We have to bring food closer to the grocery store. Vertical agriculture at scale in cities is not a bad idea to consider, especially in the here and now. And I think that those are things that we have to look at embracing, not only because of the era of scarcity, but also to prevent insurmountable human suffering if we don't get ahead of these issues. I mean, look at, it's not just things that are produced by companies either. The glacial melt that helps to provide water for billions of people is not replenishing due to climate change. So there's all kinds of different issues. I mean, we're going to a future where the idea, which was once science fiction, of water wars becomes much more realistic. And it's not just humans that are impacted by that. There's trillions of animals that are impacted by that as well. So, you know, you look at ecological decline, you look at the sixth mass extinction, you look at the food web itself beginning to deteriorate significantly. If we don't get ahead of these things, you know, we're going to have a lot bigger problems than the price of gas at the pump.
Yeah, you know, it sounds all doom and gloom if you listen to it at surface level, but you know, you are 100% correct though, and this is once again an ad nauseum. I keep coming back to this. It's better by far to embrace hard truths than comforting fables. And, you know,
Yes.
and that's exactly the kind of, and that's what I think we do, you know, and I've often been called pessimistic whenever I brought up more difficult topics or uncomfortable topics. Oh, you're so negative, you're so pessimistic. And I would say, no, I'm realistic. I can see the optimistic side of things, but I also would be very, very bad at what I do if I don't look at the negative side of things either. You know, we don't live in fairy tale land.
We sure don't.
Yeah, it's just one of those things. But I want to see if we can end off on a positive note here, you know, just for everyone else. What do you guys think is likely going to happen with these midterms and everything? Are we going to see a likely positive shift where government does get its act together a bit so that we can see some form of stability? I'm being hopeful here, Mayhem. I know I'm in your corner, but I'm being sort of hopeful. Are we likely to see any kind of positive change there, or more of the same?
I think that's the right place to look, mate, to be honest. If we're looking for a positive ending here, going into politics is just low odds.
Well, I need something. I need kind of something to look at though, because I mean, hell, you know, it's just we have this war going on. The war going on. I'm sure the Ukrainians have stepped up the efforts a lot and are squeezing the Russians quite hard, but now we have a madman threatening nuclear war and stuff. It's just like, damn, you know, what do we have to look forward to?
Things can get better, like, you know, but things can get a bit better than they are now. That's because they're so bad.
Yeah, I think that is it. And also, you know, look, at the end of the day, throughout history, often is the case that when humanity is faced with near certain calamity, they rise to the occasion.
Yeah,
I don't think this time is going to be any different in that sense. And I might come off as being doom and gloom, but honestly, there's people that are far more pessimistic than me. I think we do get through this. Yeah, I know, right? I think we do get through this, but I think it's going to be challenging. But one thing to look at too is, you know, for the last 13 plus years and really for the last several decades, we haven't let capitalism do what it's best at, which is letting companies that shouldn't exist fail. And I think we're going to see that flush, and that's actually a good thing. I know it seems very strange to say that because we haven't experienced anything like that, and there's always this propensity to bail this out and save that and whatever. I think we're going to see a decent flush, and that's going to be a good thing for entrepreneurs. It's going to be a good thing for people that want to engage in trying to do something that changes society for the better. I also think that maybe, just maybe, with all these headwinds we're facing as a civilization, that it motivates people to prioritize more than just having a greater number in their bank account or investment account. Maybe it prioritizes some concern for their fellow human being. Maybe it prioritizes looking at things from a more, you know, hey, what can we do to make this situation better for more than just myself? And I do believe it takes a crisis to bring out the best in people. So that's what I'm hoping for.
Yeah. I'm in the same corner as you there, Mayhem. And no, by the way, I don't consider you pessimistic whatsoever. You know, you're the last person I would consider pessimistic. None of us here are. I've always appreciated your objectivity, and the same goes for you, Ayesha, and for you as well, Tim. You know, we've had some very interesting conversations before, and I mean, Tim and I, especially on the Discord, we've had some very, very intense conversations about certain things before, but that's the one thing that I appreciate about all of you over here is that even if we disagree on certain points, which is perfectly fine, and yay to that. I mean, I don't want to surround myself with people who constantly agree with everything I say. we can still do it in a way where we don't start getting disrespectful. And that is something that I truly, truly appreciate. It's a very adult and mature way of having conversations. And I think maybe if we can help pass on that kind of skill to other people, they could also start seeing the wood for the trees and just having better civil discourse as opposed to fighting among themselves. My 2 cents.
Love it.
Yeah.
So yeah, guys, thank you very, very, very much for the time that you gave me today. I think we've pretty much covered everything that we wanted to talk about, and I am so looking forward to releasing this episode. So I'll send you all the links as soon as I'm done uploading it.
Thank you.
Thank you, mate.
Anytime.
Thanks, Adrian.
Have a good one, guys. Enjoy your day.
You too.
Bye-bye.
Bye.
Thank you for listening to the Heart Red Spade podcast. For more information, please visit our website at www.blackheartredspade.com or follow us on Twitter at BeHeartRSpade.